A third factor that can impact yield to maturities is inflation protection. Remember Fisher's Law, and you've seen this from your macroeconomic courses. There is a relationship between the nominal rate, which you will see, for example, quoted on yield curves of treasuries, real rates of interest, and inflation rates. If we have a nominal rate of interest, we have a prevailing inflation rate, our real rate of return is going to be less than the nominal rate. Those relationships are stated there in that first equation, relating nominal rate of interest to real rate of interest to inflation rate. We then use that equation to impute, in the last three equations there, either the nominal interest rate, the real interest rate, or the inflation rate from the other two factors. Let me just give you an example. Real rate of interest is 3%, inflation rate is 2%. In this case, our nominal rate would be 5.06%. Stated alternatively, if we have a 5.06% rate of return and an inflation rate of 2%, we would have a real rate of return of 3%. Our money at the end of that year, if we invested at the beginning of the year, had a 5.06% nominal interest rate on the investment, inflation rate was 2%, our real rate of return would be 3%. We would be 3% better off, if you will, at the end of the year. Another example, if we have a nominal rate of interest, inflation rate, we can calculate the real rate of return, and in this case, our real rate of return given a nominal rate of 3%, inflation rate of 2% is 0.9%. In this case, holding an instrument that has a 3% interest rate and inflation prevails for the year is 2%, we're better off by 0.9% at the end of the year. Or we have 0.9% more real dollars at the end of the year. Over our history, we've seen different periods of inflation in the United States. During your lifetime, which I'm assuming began about 1990, we've seen inflation rates about 2.5%. And in recent years, we've seen those below 2.5%. Inflation was a real concern during the 70s and 80s, and you can see that during that 70s and 80s period, we had inflation rates approaching and over 12.5% at the beginning of the 1980s. If you go back to the 10-year Treasury rate and look at the peak of those 10-year Treasury note returns, it will coincide with that high level of inflation at that point in time. That was a period in time when we were very concerned about inflation. Jimmy Carter appointed Paul Volcker as chair of the Federal Reserve Bank, and we wrung out inflation of the system in a very what turned out to be a very, very difficult process. But people my age and older remember those periods, and so we are concerned with inflation. During your lifetime, you haven't seen large amounts of inflation, but there's always hearkening back to that period. In recent times, some of the concern has been, since 2008, we've had very low real rates of interest and inflation rates, but we've expanded the money supply exponentially. If we look at macroeconomics pre-2008, there was Milton Friedman's famous statement, inflation is always and everywhere a monetary phenomena, that you think of, if we expand the money supply, we would be seeing inflation. That is now there's considerable debate about that theory, one, and how you measure the money supply overall. But that's a debate that will continue during your lifetimes, and we'll see in the future if we have another period of inflation. If you're thinking about the high amounts of debt levels that are being spent today, one of the concerns is that federal governments will not be able to maintain that level of spending, and inflation may result. That's not going to happen next year, but it is a concern. Here's a more closer look at inflation rates from the Bureau of Labor Statistics. Google that, and you can always get that map updated, and you can see there that right now in recent years we've been running below 2.5%. I want to also show you one other graph, which is the yield to maturities on 10-year tips. So this goes back to 2002 and shows you what the yield to maturities are on tips. So this is a 10-year tip. This has inflation protection in it. Remember that we calculate yield to maturities given the scheduled payments. There is not in those calculations an increase for inflation. It's essentially holding inflation rates constant. So when you're looking at those negative rates that have existed, for example, from 2012 to 2013, 2020 on, what you're doing is saying something about the real level of interest rate, which is very low at those points in times, and also in the inflation rate. Again, going back to the earlier item, if we have a 10-year Treasury yield, constant maturity without inflation protection, 10-year tip, you can use Fisher laws to imply what the market is saying about inflation. In this case, if we have a 1.6% yield on 10-year notes, 10-year tips is minus 0.68%. The market is implying that there's a 2.3% inflation rate. That gets a little bit more complicated to calculate as we're looking at it's the same phenomena as forward, spot, and yield to maturity curves. Just harken back to that discussion. So there is the calculation of that. And if you have inflation protection, you should be expecting lower yield to maturities than without it.